An unsustainable surge in car sales. Let's have a look. Hello everyone, Florian Heiser here and welcome to another episode of Heiser Says. I've got my stein of coffee and I thought we'd have a look at this article from financial news analysts and data regarding car sales and how they may be, well, not sustainable. Now here in Australia we have seen, and I'll just bring up some data with regards to car sales, they've been declining this year. It hasn't been doing too well. But recently I've had viewers who work in the industry reach out to me and say, business has been booming. It's been going very well. All of a sudden people have been appearing asking for cars. If it was one person, they'd be asking for what they could get for 10,000. If it was a couple, they'd be asking for what they could get for 20,000. So in some ways, it seems people are buying cars with their super. And it's making an impact on the market. Now, car purchases always take a hit in a recession, and there's been a lot of discussion just of declining car sales all around. A big part of the car industry is the rental market, and that's when you go overseas, go on a nice holiday, and you buy a nice rental car, and it's pretty much a week or 2 weeks of experiencing a nice car, and that will in some ways encourage people to buy that car when they get home. And that sector has taken a big hit because tourism, well, it's essentially non-existent right now. So let's have a look at this article, everyone, and see how this will play out around the world and in Australia. Surge in car sales, leads may not be sustained. Carsales.com has signaled a surge in inquiries. Of course, it's always just about inquiries, isn't it? Is that what the share market is responding to? Just web search traffic? It feels like it, doesn't it? It feels like everything we're looking at. Surge in inquiries here in property. Search results are up, so that means the market will shoot up. Not that people don't just like looking at things. It's like window shopping, but in your bed, in your pajamas, drinking a nice coffee. So they've signaled a surge in inquiries regarding motor vehicle purchases since April, but many of the factors producing these leads could be short-term in nature. Carsales.com has surprised the market, signaling a very strong growth rate in inquiries regarding the purchase of motor vehicles since late April. The company's Korean business has also sustained good growth for financial year 2020. Moreover, car sales, having previously withdrawn guidance, issued a new operating earnings before interest and tax, ranging to 220 to 206 million for financial year 20. The midpoint of the range is 4% ahead of Credit Suisse's prior forecast. The broker accepts the recovery may be faster than previously expected, but still anticipates limited underlying growth in financial year 21. This is on the basis that lead volumes will slow once government stimulus rolls off, and costs will probably increase as some of the reductions stemming from the pandemic are of a one-off in nature. The recovery has been faster than expected for dealer inquiry volumes, in particular since the end of April, while dealer support measures have been removed since June. UBS expects the majority of the lost dealer revenue will return in 21, but with minimal incremental growth. We'll see how that plays out here in Australia, particularly when all the support mechanisms are withdrawn, with JobKeeper, Job Seeker Bonus, mortgage holidays, when they all disappear in September, when trading while insolvent, get out of jail free changes to legislation is removed and adjusted in September. It's all going to happen in September. It's definitely going to be interesting, isn't it? The broker assesses the lift in inquiries is being driven by the JobKeeper payment stimulus, early access to superannuation, and favourable instant asset write-off tax rules. I forgot about that one. I forgot about the ability to instantly write off, which I love, to be honest. I think that's a great way to encourage businesses to spend. But then buying simply for the tax deduction often isn't the smartest thing to do. It has to be planned out, everyone. You don't want to fall into the trap of going, it's a tax write-off, I'll spend. There needs to be either demand for that investment into your business or part of your growth strategy that you already had in place. Somehow I think that's not always happening. Pent-up demand for cars after physical restrictions are lifted from the height of the pandemic is also a feature, as well as a potential rise in car ownership because of fears of public transport. Well, yeah, I guess you don't want to be surrounded by a bunch of diseased people, do you, in public transport, or just in a confined metal cylinder with reticulated air conditioning. However, many of these features may fall away, and UBS emphasizes the economic outlook remains uncertain. Hence, minimal growth is expected in financial year 21. The broker is also mindful that the company will be removing dealer used car discounts from June, while new cars remain free of dealer lead fees. However, new cars are only a small portion of the company's dealer base. Morgan Stanley assesses the start of financial year 21 is likely to be more positive than previously expected, and although there are risks around the shape of the recovery, retains an overweight rating. Macquarie is less optimistic, downgrading to neutral following a 41% increase in their share price since late April. The good news is mostly about the short-term, and longer-term implications are more modest. Well, that's it. We've only just begun. This recession has only just started. It's only just started. I know some people are saying, we've been in recession since 2008. No, technically we haven't. You need 2 quarters of negative growth. We've only got our first quarter. We need to see the next quarter. GDP growth per capita has been below trend since the GFC, but we've still been growing. I would argue certain industries most certainly have been in recession, particular sectors, but not overall as a nation. The broker agrees part of the strong growth rate in lead stems from cyclical and one-off factors. In the case of cyclical influences, this should normalize over time and have little bearing on the longer-term trends. While car ownership may be rising to some extent as a result of the pandemic, it remains a modest positive for the company in the long term. Used car listing volumes are now down around 30% compared with the year ago. So the broker assesses supply and demand is out of balance. Hence, dealers are looking to replenish stock, which may stimulate the use of instant offers and draw out more private sales. On the other hand, new cars may become better relative value. All up, Macquarie does not believe the current level of leads will be sustained for very long and will revert quickly. That said, the broker concedes car sales remains a core and dominant platform for used cars for dealers, and this should continue to be the case as the market recovers. Meanwhile, debt maturing in July 2021 has been refinanced, and the facility increased to $650 million, which removes any residual concerns regarding the company's balance sheet. The sale of Stratton Finance has also been confirmed. Car Sales intends to retain a dividend payout ratio of around 80%, driving brokers to increase or reinstate dividends in their estimates. FN Arena's database has 3 buy ratings, 3 hold. The consensus target is $16.07, suggesting a 10.7% downside to the last share price. Targets range from $14.58, Morgan's yet to come to the update, and $18 for Macquarie. So, well, there you go. We'll have to see how this industry copes. Because honestly, I think it has really been, JobKeeper, and it's been the super withdrawals that people have used to buy a vehicle. Is that a good thing or a bad thing? Sometimes you need a new vehicle. But then again, sometimes it's better to just put up with a Humpty? Save money? Get something a bit cheaper? We'll have to see, everyone. We'll definitely have to see. I think a lot of people will just keep holding on to their car, keep it going, ride it into the ground, rather than invest in something new. Because a car is it's not really an investment, is it? The instant you buy it, you lose 10% when you literally drive off the driveway. And, they always want to suck you into car finance. As always, please let me know your thoughts and opinions. Are you involved in the car industry? Have you seen an uptake in people coming in? Do you think there's going to be more demand for vehicles because of the pandemic? Has that adjusted your behaviors? Are you avoiding public transport? We'll have to see, everyone. Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and would like to support the content I make here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us via using our affiliate links at Amazon or eBay or Independent Reserve and KuCoin. You can buy our merch from Heiser Says. Right now we have pocket squares that Rachel has made. You can see right behind me. We have Gold Pass from the Perth Mint or PayPal. Thanks, everyone. Have a great day. I'll see you next time.